Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time and inform the most relevant, compelling, and challenging conversations. Here we offer first-person access to dynamic political, business, and public personality.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon again, and a special welcome to those of you joining us online at canadianclub.org. Thank you for sharing part of your day with us. My name is Glenn Parkinson, President of Canadian Club Toronto, and your host today. As I mentioned before lunch, right now is a terrific time for a PE discussion. I'm not even going to mention the capital gains inclusion rate, but somebody might. But first, I'd like to take a moment to recognize the sponsors that allow us to do what we're doing today. Today's event is sponsored generously by PwC, so thank you for your support. I'd also like to thank Canadian Bankers Association, our season sponsor, Air Canada, our official airline partner, and Canada's Forest Trust Corporation, who partners with us to offset our carbon footprint from the entire season. So thank you to Canada's Forest Trust as well. Now, those of us who have been to a few of these events, I count myself among them, know that we often invite student leaders to join us today, and today we are pleased to welcome a table from the University of Toronto Rotman School of Management. And our events, lastly, I'll just point out, our events encourage participation and questions from the guests. So for those of you in the room here, you'll see in the center of the table or scattered across the table a question card. So if you have a question for our panelists, please fill it out on the card and hold it up, and our volunteers will run the questions up to our moderator. Similarly, for those of you online, there's a button on the right-hand side of the screen that says click to submit question. So use that button as it sounds, and we'll get the question up to the front as well. At this time, I'm pleased to invite PwC's National Private Equity and Pension Fund leader, Mike Shea, to introduce today's speakers. Michael, welcome to the podium.
Good afternoon, everyone. On behalf of PwC Canada, we are delighted to host the second annual Behind the Curtain Outlook for Private Equity in Canada. Now, just over a year ago, we met for our 2023 Outlook, where much of the discussion was focused on headwinds in the space, including navigating various macroeconomic and geopolitical risks. For example, as expected, these challenges had a meaningful impact on the sector in 2023, which was felt across the M&A lifecycle. For example, despite relatively high levels of dry powder, M&A activity in 2023 was slow, driven mainly by a lower supply of quality assets in the market and widening bid-ask spreads. In addition, fund liquidity and the ability to return cash to investors moved into the spotlight, and many investors' focus shifted away from IRR more towards distributions to paid-in capital. This caused challenges in new fundraising, pressures for exits, and the continued emergence of fund liquidity solutions, such as secondaries, continuation vehicles, and NAV loans. While many of these challenges have persisted into 2024, we are beginning to see some green shoots. Macroeconomic factors such as inflation and interest rates have begun to stabilize. In addition, bid-ask spreads have narrowed, and there is a renewed willingness to use earnouts and other structures to help bridge valuation gaps and help facilitate deal-making. There also continues to be significant amounts of dry powder needing to be deployed. This could help accelerate deal activity, but it also means that GPs will be faced with the pressure to deploy versus having the patience to do the right deal at the right price. This is where value creation will continue to come into focus. And funds who are able to underwrite and execute on upsides, driven by more advanced value creation levers such as digital, technology, and generative AI, have an opportunity to emerge successful. All that being said, I believe now is the perfect time to regroup for a discussion on the outlook for private equity in Canada. And we are lucky to be joined by a diverse group of panelists providing perspectives as PE allocators and investors across different transaction sizes, strategies, and sectors. I'll ask that you hold your applause until I introduce all of the panelists. First off, we have Jennifer Pereira, Managing Director and Group Head of Private Equity at Fengate Asset Management. Laurie Hall Kim, Senior Managing Director and Head of Global Private Equity at Healthcare of Ontario Pension Plan. Anish Jan, Managing Director in Brookfield's Private Equity Group. Kirk Hamilton, a Managing Director at Kensington Capital Partners, leading their mid-market private equity business. And last but not least, our moderator, Joseph Lowe, who is a partner at Sagard in their Canadian private equity business and the past president of the Canadian Club of Toronto. Ladies and gentlemen, a round of applause to welcome our panel.
Okay. Good afternoon, everyone. Mike, thanks so much for the warm introduction and for PwC's support. Just a reminder to everyone in the audience, as Glenn stated, these events are really made what they are by audience participation. So I do have a stack of questions here, but I'm sure yours will be much more interesting. So do welcome them both online and here in the room. Laurie, Anish, Kirk, Jen, great to see all of you today. Let's start maybe by setting a little bit of the backdrop for the group today. There's lots going on in the world. Macroeconomic risks abound. Highest rate environment, highest inflation rates we've seen in a generation. The U.S. presidential election is, if you can believe it, just about 5 months away. And we've got geopolitical tension, if not war, throughout many regions in the world today. So against all of this backdrop, each of you bring, I think, a unique perspective given where you sit. Laurie, let's start with you. In your role at Hoop, you're a global investor. How would you characterize the moment that we're in today?
Yeah, thanks for the question, Joseph, and I'm really happy to be here. So thanks to the Canadian Club for having me. So you're absolutely right, and I think you've painted the picture really well. It is a very uncertain environment, and if I start maybe with a comment about where we are and have been for the last 18 months, I think the best way to describe it is just extreme uncertainty. And we've seen that impact transaction volumes. Michael's comments just touched on that as well. I think, in a world where cost of capital is very low, valuations are rising, it's hard to not make money, hard to make a mistake. Where we've been over the last 18 months is a huge contrast to the period leading up to, call it late 21, 22. And I think in that environment, you need a lot better information, you need data, you need time to assess what you're looking at and where things are headed. And when investors struggle to do that, companies struggle to do that, management teams are struggling, everything grinds to a halt. So it has been tough. And I think, the expectation that interest rates may, and in fact, we're seeing that be higher for longer, really means that you have to adjust your expectations for the future. And buyers and sellers have had very different views on what that means. So that's kind of where we've been. Now, if I secondly touch on the outlook, and I think that's what we're here to talk about, it does feel like there's relief on the horizon. So, we saw CPI numbers in Canada, 2.7%, the latest released data, and that starts to feel like some of the pressure is easing from an inflationary standpoint. And I think the passage of time has allowed companies to develop more of a track record post-COVID where the trends in their performance are a bit more reliable, and that gives buyers a bit more confidence in how to forecast the future. And I think everyone has come to grips with what it means to operate with a higher cost of capital. And when you put all that together, it does feel like some of that uncertainty is unwinding. And we are optimistic that that's going to mean a return to transaction volumes. So certainly coming into the start of 24, everyone thought it was going to be sooner than what we're experiencing now. And as we just come up to the half point of the year, it does feel that the second half will start to see the logjam start to move again. We are seeing more opportunities in our pipeline. When we talk to our partners, and we have a number of GP partners who are in the flows every day, and we do that directly ourselves as well. So across all of that, it does seem that more companies are coming to market, preparing to start engaging with the sell side again, or with the buy side again, and they have more realistic expectations about what their businesses will be worth. And from the buyer's perspective, I think we now have a better opportunity to forecast a future that accounts for a higher cost of capital over a longer period of time, where we know what the opportunities will be for value creation, and we know how much we're going to need to rely on that value creation to deliver returns, because we can't rely on financial engineering anymore. So I think all of that takes time in a transitional period for buyers and sellers to accept the new reality. And with where we are today, it feels like we're right on the cusp of everything sort of getting moving again.
Anish, maybe building on that a bit, Lori's comments really kind of straddled a bit of kind of the rearview mirror and a bit about what we're seeing before us and what's to come. Do you see a dichotomy between perception of risk, which maybe is an echo, versus kind of what you're seeing on the ground? Obviously, Brookfield invests globally. You have a broad view of what's happening. What are you guys seeing?
Yeah, no, thank you, Joseph, and again, thank you to the Canadian Club for having us. Without a doubt, risks are elevated today. But that doesn't mean that risks haven't been present or pervasive in prior times as well. And at Brookfield, the approach that we take is oftentimes thinking about a through-cycle, long-duration investment. What are really the macro themes, talking about this as a decade or longer type of horizon. And so from that perspective, while we're seeing geopolitical risks, there's not necessarily broad-based financial risk, but there's uncertainty around the rate environment. Potentially we are at a crest. There's a question here about where do we want to deploy capital, and then this question around, is it different from a risk perspective globally or centrally versus on the ground and locally? And so I think what's really surfacing is having purely a single data point or a holistic global perspective is insufficient to really navigate the risk that's pervasive. And so what you're seeing is that teams are becoming globally coordinated, but more locally present. Various allocators of capital are thinking about, where do I want to have a presence on the ground? How do I put people into those markets? Because navigating risk requires you to be able to think about what are the specific nuances in each of those markets. So Brookfield today, as an example, we're in 30 countries. We have teams spread out across the world. Some of those teams sit within different verticals, different parts of our business, not necessarily private equity, it may be infrastructure, real estate, renewables. But how do we think about being more broadly coordinated as an organization and then leverage that local awareness that we're developing? I think if we try to navigate and mitigate those risks in a specific market and do that from a central point, it would be insufficient for us to prudently invest. And so it's necessitating for us to leverage these local teams, the local know-how, what do we understand from the existing assets that we own that are locally present? Because while we are in 30 countries, our portfolio companies expand a much broader set of nationalities and countries, and ultimately leverage the insight that we're generating.
Really helpful from a global perspective. Kirk, turning to you, you and your team invest primarily in the Canadian mid-market. What's peculiar in the markets where you're most active, and frankly, have you seen opportunities as well in this time?
Yeah, I mean, I think if we think, despite being a mid-market investor in Canada and in the U.S., to a lesser extent the U.S., I mean, you can't run and hide from rates. You can't run and hide from inflation. You can't run and hide from a tight labor market, right? Like all of those things will always be kind of ever present in, the ebbs and the flows through the period where you're holding a business, holding an investment. And so, you need to be prepared for, for changes in those environments. Kind of gone are the days where in the mid-market, it was buy a platform, get some cheap credit, add on, and then multiple expansion, bada bing, bada boom, that's your value creation plan. That doesn't exist anymore. And so there's far more focus on, where can we find, organic growth in the business? What is tangible when we look at an investment where we can, draw a straight line to an execution plan to drive value, right? And so, from our perspective, it's coupling that and then coupling, broad thematics around sector, subsector, where are we seeing the opportunities in the market where there's some really strong underlying tailwinds in a non-cyclical industry, pick healthcare services for an example, where we have two platforms. Those are the places where we're looking to allocate capital and to drive value creation is through the organic piece, and far more to a lesser extent the M&A that you would have seen 2-3 years ago.
Great. So stick to the knitting and build on it. Jen, Fengate invests on both sides of the border, maybe like Kensington as well. Your latest investment is in a food company in the U.S. What comes to your mind as a Canadian investor investing south of the border in the moment that we're in?
Sure. I mean, I'd start by saying, similar to how we built out our real estate and infrastructure strategies, we're following the opportunities. And so at the end of the day, that's what's most important to us outside of geography. But as we think about Canada and the U.S., Canada is a fantastic market for lower middle market opportunities. There's a rich set of companies that we can take a look at and an existing network and brand that we have here. So it's a natural place for us to spend time. Having said that, the U.S. provides us with a much larger TAM to go hunting and prove out our theses, and it also lets us diversify away from Canada. So, we see them as complementary and very much, one region. The other thing I'd say is at the end of the day, what matters the most is that we have a clear angle, right? And so regardless of where we're looking, we need to make sure it's a Fengate deal, be that, it's ownership and founder transition, an M&A thesis where we can leverage our originations team, a real assets adjacent business because we understand those end markets. We're really focused on that more so than the geography. Now, that being said, you raised some good points on the macro risks in the U.S. right now, and I think we're being extremely cautious in more regulated sectors. So let's take healthcare, for example. We've seen the recent bill proposals in California around private equity. We've seen the litigation from the FTC in Texas. This is a sector that requires deep experience and expertise before you wade in U.S. healthcare. And it's one of the reasons we recently hired a senior investment professional to our team who brings that experience. We're very much focused on first understanding a market before we actually execute in it. I think Seiko's an example of that. Standalone, fantastic asset, met a lot of our criteria, very well run, had organic growth, diversified portfolio that actually performs really well in a recession or times of uncertainty, and also helped us execute one of our theses, which was, hey, we're seeing all these Canadian food and beverage opportunities, and 9 times out of 10, the CIM says, we're gonna grow in the US. Well, we thought, what right does Fengate have to execute on that thesis? But wouldn't it be great if we could find a distribution partner that already had a portfolio and then go and acquire Canadian assets and scale them through that? It's been about 5 months since we've done that deal, and our team, through our originations team and our network, have already brought about 8 opportunities, many of them from Canada. So early days, but we're off to the races with that thesis.
Congratulations. Maybe let's let's think about the environment in a slightly different way and more tactically how your funds are reacting. So we've talked, and Mike touched on it, how the momentum has shifted. So the rate of exits is down, the quantum of distributions back to LPs is down, fundraising for GPs has been pretty tough over the last 12, 18 months. Now, on the other hand, this environment has fueled some innovation as well in the form of continuation vehicles, NAV loans, secondaries. Kirk, how are you seeing this part of the market evolve, and how is it changing how you're doing business at Kensington?
Sure. I mean, the launch of all these various products, be it continuation vehicles, be it the growth and flow in the secondary market, be it preferred equity solutions, the GP stakes environment that's going on right now. All of these new products that have evolved into the market and are becoming more and more accepted and more commonplace are tools in the toolbox, not just for GPs, but also for LPs as well, in terms of figuring out what giving them optionality around liquidity. Okay, so for us as Kensington, we're a little bit more unique than a typical private equity firm where we're an open-ended structure, constantly managing capital calls from underlying fund investments that we have, distributions, new investors coming in, and distributions to our current investors. So it's effectively a large cash management exercise that we're constantly going through. And so having some of those tools out there in the market to help us manage liquidity, but also participate in continuation vehicles where we see opportunities with GPs who we have strong relationships with, who we deeply believe in the thesis where they're launching a continuation vehicle is very helpful for us to sop up excess liquidity that we have in our fund. So all of these new tools in the toolbox are facilitating, in my view, a more appropriate product that can be structured for retail and users. And so that's a really key thing. What I would say as well is, people are talking about the ECM market and IPOs and the really muted environment that we see in ECM, and a lot of that's driven by optionality that GPs have now with respect to how they want to manage liquidity. And is there more value creation, meat on the bone, where they can continue to stay private for another 2, 3, 5 years and see through and execute on that thesis that they always had? And so, these new tools are allowing private equity far more flexibility than they've ever had before. So,
Laura, you're in a unique position of being both an LP and a GP on this panel. So with your LP hat on, how are you feeling, and what's the direction that you're giving to GP partners?
Yeah, well, I think firstly, we're investing pension assets on behalf of healthcare workers in Ontario. So when you talk about a long-term perspective, I think that's very much the lens through which we see things. And as a result of that, we're trying to build strategic partnerships with our GPs that last over multiple fund cycles and economic cycles as well. So I think the partnership approach that we take and being able to leverage our internal team and resources to be a good partner and help GPs when they need support underwriting deals is very much part of our DNA. And so those dialogues are very interactive. When it comes to liquidity management, I think DPI has certainly been the focus, and GPs are realizing through lived experience that really you need to return capital to support the fundraising market. I mean, we have talked to many of our GPs about the focus on portfolio management, liquidity management, and we'd much rather see our GPs focusing on creating value and then monetizing that value rather than coming back to a challenged fundraising market too early or with fund targets that are larger than what is realistic for this environment. So I think we want to be supportive when it comes to tapping into the various liquidity management tools that are available, including things like continuation vehicles, but also, would speak to our GPs about managing expectations around the fundraising market, fund sizing, and rather than extending the fundraising by another 6 or 12 months, let's just put a pin in it, get to the job of investing, and then come back when things are better. As it relates to some of those tools, continuation vehicles in particular, there's a lot of discussion in the LP community about the use of CVs and also NAV lending as an area that I think LPs really just want to see transparency, and I think that's a conversation that continues to evolve, particularly around NAV lending. So there are certain situations where those tools can be very effective, but I think what's most important is we need to know when they're being used and what that does to the risk profile of individual assets and the fund. And that's a conversation that needs to be had with your advisory committee. Continuation vehicles are interesting. I think Kirk made the point, you've got some of the best performing assets that GPs continue to believe have a long runway for continued value. We're seeing, the rollover of carried interest into those deals, new funds coming in alongside those deals. And I think importantly at Hoop, we have the capabilities within our team to evaluate and assess those opportunities and make an informed decision about whether we want to roll or take the exit ramp when that's available to us. Not every LP has those capabilities and is able to respond in that way. And I think for those that struggle to make those calls or have a programmatic answer, the continuation vehicles can be challenging because that's not what we signed up for initially. But one of the things I've always appreciated about the private equity industry is it's full of really smart and creative people. So the innovation around finding ways to generate liquidity, get things moving again, and finding ways to work with all of the partners around the table is something that I think as an industry we've done pretty well in partnership with GPs and LPs across the table.
That's great. Jen, I want to pick up on a comment that Lori made in the opening, and that was around the log jam starting to get a little bit unstuck. And so we know about the record levels of dry powder that GPs are hanging on to right now. 1.2 trillion was the last number that I saw. I can't count that high. There's a lot of pressure, obviously, coming top down to Lori's point of kind of getting back to the job of investing. How do you balance that pressure to deploy with continuing to be smart and continuing to be returns focused?
Yeah, I mean, that's the job, right? That's the hardest part of it, I think. When you look at the deployment for our fund right now over the last few years, we've effectively done just one deal per year, and that was intentional, right? And so we are, relatively speaking, slower on deployment. So like many others, we have dry powder. That said, we also think it's a really attractive vintage to be investing in. These times of uncertainty can unlock some very high quality assets if you really understand the space and have conviction. So what we're doing is really rethinking a little bit the way we go to market. And specifically, it's been a few things. One is taking a more sector-focused approach. And when we say sector, what we're really talking about is the subsector. So similar to what Kirk was saying, it's not enough to say, we want to do business services. It's, no, I'm looking at facility services, and within that, I'm specifically looking at A, B, and C. That level of specificity can give a small team like ours the ability to go deep and focus and find the best assets in that space and avoid the risk of potentially making poor investments, but also increase our conversion rate because the sellers see that. The management teams see that understanding, they see that conviction, they see the thesis, and they want to partner with that. The other things we've been doing is we've actually cross-staffed, so we have an originations team and an investments team. We've cross-staffed those sectors, so you have continuity of coverage from originations with the deep sector knowledge and deal making of the deal teams. We've also been building out a best-of-breed network of advisors, which has helped us unlock our last 2 deals. And I think that's really important as an emerging manager. We don't have the decades of experience of some of our competitors, and so what we lack in our own experience, we try to complement with the best operating advisors that we can find. And then finally, we've been building the team. We've grown it by about 4 people already this year. So we are ready and rearing to go, but I think ultimately we want to do so on assets where we can get ahead of processes, have a real angle, ideally a proprietary one, and convert that into a deal. And you saw that playbook play out on Seiko.
Great. I know we've got a few minutes left for the conversation today. I will kind of remind everyone, we'd love to get some questions from the audience. So whether you're joining us virtually or here in the room, please don't be shy. Let's talk about value creation, Anish. I think we've heard from, I think every single panelist already has talked about the importance of focusing on the assets, being developing a perspective and delivering value, and maybe taking advantage of certain products in order to run down that runway a bit further. How is Brookfield looking at value creation differently in our current environment? Maybe touching on some of the more advanced technologies and innovation in the area.
Yeah, sure. I think I'll maybe split that into, there's the advanced technologies part, and then there's just broadly value creation. And so Brookfield, again, given its history, over 100 years as an industrialist, deploying its own capital, and then really only in the last 20 to 30 years taking external capital, has always maintained one driving theme in its value creation, which is proximity to the business. It's how we think about our own internal resources, people who've come into private equity after having run businesses or actually been inside industrial assets, to then also how we continue to think about value creation as a high degree of touch, a high degree of closeness to the management teams, to the assets. At times, we ourselves might step in an interim capacity to help run these businesses if we think delivering on that value creation is something that is so critical from a timing perspective that we don't want to have any interruption as we make changes in those businesses. So I think regardless of where we are from a cycle perspective, what technologies are out there, we continue to have this prevailing theme around proximity and how close we want to be to these businesses. And we think some of our peers maybe delegate more of that capability external to the four walls of their own firm and to the GP. From a technology perspective, Gen AI is likely the most prevailing theme and headline that's out there. And we think of it as ultimately being one of the most transformative tools of productivity that has likely surfaced since maybe the deployment of the personal computer. We are early days, we are dipping our toe into it. There's a low level of maturity sort of inherent to many of the businesses that we buy, these core industrial businesses. They maybe weren't necessarily on the cutting edge of technology to begin with, and now we have a cutting edge technology for them to utilize. But broadly speaking, we have data accumulation has taken place. Thinking about awareness, how do we ultimately have sensors and understanding of what is transpiring across the different assets and personnel inside of our companies. Then it has gone to a data aggregation. How do we pull all of that together and think about data lakes and ultimately having bodies of information that we can mine, and data scientist teams that are navigating that. And now with Gen AI, we're really in an unprecedented time of data synthesis. How do we think about the ability to stitch together all these different components that we've been able to observe and accumulate to now think about what is the insight generation that's taking place? And if you think about the types of businesses that we have and the size that we're deploying capital, these are large global businesses, oftentimes core pieces of infrastructure, whether it be literal infrastructure of ports, roads, railways, or industrial assets, important pieces around energy, batteries, transportation. We have a great knowledge base for us to go and synthesize against. And so as we think about value creation, one, we want to have that proximity, and how do we have operating partners part and parcel from day one when we look at an opportunity, and then maintain a close degree of awareness around the asset. But then also, where can Gen AI help us as a firm where we have presence in 150 countries, where we have 200,000 people across all of our portfolio companies, all of this information that's coming together, where can we synthesize it better? The rudimentary examples that we have are how do we think about mining data, doing RFPs, responding in an automated way around pricing or customer inquiry. But the real potential for us is how do we take all of this information that we generate across our broader platform and then have that inform on the front end what are the different levers that we can pull for value creation.
Joseph, if I could jump in on
Please.
this topic, because I think Anish has hit on so many things. And one thing for Hoop, I feel that we're in a very privileged position because we do have partnerships like the one we have with Brookfield and many others, where we have access to some of the biggest pools of capital and the biggest portfolio companies. So at Hoop, we've also been on that journey, and I think are investing the time, energy, capital into the tools that can help us really mine that massive set of data, whether that comes from our direct holdings on the direct investing side of our business, or reaching into the portfolio companies, which stretch across thousands of companies across all of our GP relationships. And then, as you say, using that data for insights. So much of what we're focused on right now is thinking about how we use Gen AI and all of the data that we have access to, not only for our own investments and the ability to generate value for our members, but then also how do we ourselves get better at what we do every day. So we want to help with our portfolio companies be able to spot trends, and whether you're disrupting or about to be disrupted, providing those insights and leveraging that information for all of the portfolio companies that we're supporting, and then also leveraging that for our own investment insights and what we do and how we run our business every day. So there's really 3 buckets where Gen AI has an impact, whether that's portfolio, our investment process, and just the way we run our business and our company every day. So lots of work happening on that front at Hoop as well.
So I don't know if it's the same. Both of you could just say what I just said a minute ago to this question that came from the audience, but you may or you may not, and I think Jen and Kirk may have a perspective as well. So if value creation is one side of a coin, productivity is, call it, the other side of the coin. And so the audience question is this: how can private equity uniquely help Canada's productivity issues that are so well publicized today? Is there a unique position that the 4 of you or the industry can play? And it's open.
Yeah, maybe this is not a specific answer to the Canada element of it, but I think more broadly around private equity and capital deployment. Many of the times that we step into a situation, again, and maybe this is an industrials-oriented comment, it's because capital allocation has been inefficient and the utilization of the assets that capital has been supporting is suboptimal. So you have lower throughput, you have lower productivity, people have been chasing maybe more passion projects and have not been as disciplined around how do they ultimately allocate capital, whether it's R&D, hard assets, G&A. And so private equity comes in and can take a more clinical approach, bring process to this capital allocation decision, and ultimately generate a higher return on that capital than it would have been generating otherwise in a less disciplined process. And so ultimately, as we think about the Canadian market, though probably for any market, this question is, how do we make this a market that is attractive to invest in? Private equity, because of that discipline, because of that process, effectively is able to invest in more situations than maybe capital would otherwise generically be able to invest in, because it's able to sweat the assets, if you will, more effectively than if you didn't have the discipline, didn't have the process, didn't have the practice in deploying capital.
Yep. I think there's an element of a platform, the power of the platform as well. So I think Anish is talking a lot about the process and discipline that comes to portfolio companies. The other benefit is for smaller mid-market companies, there's a limit to the resources that they can tap into. And when they have institutional investors, private equity investors backing them, they get the benefits of the platform. And that opens up access to resources, information. It's really tapping into that wide pool of data points that you then, as a mid-market Canadian company, can tap into in a way that wouldn't have been available to you without the benefit of your investors coming to help you with that. So I think that is another way that, particularly in the Canadian mid-market, private equity has a role to play in helping accelerate the progress for our Canadian champions.
Kirk and Jen, would you agree with that assessment in the mid-market?
For sure. I mean, I totally agree with everything that Anish and Lori have said. I mean, I think when you have, and again, I'm looking at everything here through mid-market, lower mid-market lens, right? So it's not necessarily a national or global picture here, but our focus is always going to be to drive equity value, right? And when we're going through our value creation planning and we're thinking about the businesses and the platforms that we have, what we're trying to do is build out and invest in this business, invest in the people, invest in the assets, invest in all of the resources that go into creating a lower mid-market business, moving it into the mid-market, and then moving it into the into a larger call it maybe a pan-North American business. For instance, we have a building products business in Collingwood, and we just completed an add-on in California, and that business was very small a number of years ago, and it's grown as we've invested and grown it over the past few years. And so, fully agree with the assessment from Laurie and Anish, and I think having a more active private equity community here in Canada will continue to help drive productivity, drive new businesses, and drive growth.
Yeah, I agree with all of that, and maybe I'd add a slight other side to it, which is the people element and the talent element. I think
that was the next audience question. Oh. Talent.
Let's
go.
You want me to wait? I'll just go.
Yeah, go with it.
Well, I was going to say that our timelines are 3 to 5 years. That's not a long time to create value. So going back to the discipline point, we really not only want to be able to invest the capital effectively and efficiently and manage the budget, but we also want to make sure we've got the best talent in place and we're motivating and aligning that talent to our outcomes. So we find as First Institutional Capital, just setting up that management incentive program can really change the behaviors, even with the existing team, and applying that rigor to managing your talent can create real productivity and value in addition to automation, in addition to bringing in best practices from other portfolio companies and the benefit of the platform. So I actually think it's a bit of both.
Do you find it scary for that talent? Do they have to get used to the private equity playbook, or how do you bring them along?
Yeah, I think that's probably one of the biggest changes from my moving from large cap to lower middle market is before I was, investing in a business that had been owned by private equity 2-3 times. Now I'm often the First Institutional Capital. So there's a lot more of an investment in education, relationship building, trust building, and alignment building. And that's at the upfront of the investment, but then all the way through, right? It's probably the biggest use of our time at the beginning is making sure we've got that alignment there, and that founder or that entrepreneur really does want to bring private equity on board and is aware of what that means, where the value is, and where things will feel a little bit different. So we've definitely had to spend more time up front for first-time investments.
3 to 5 years without a continuation fund, though. Yeah. But I agree with Jen. I mean, it's something we spend a ton of time thinking about it is talent, and it's not even necessarily just in the portfolio company itself, but also when you're thinking about building thematics around what sector, what subsector, how do we get specialized, how do we have those angles in the market, having folks who have lived the private equity experience in those subsectors in the markets that you want to be, who can help identify good targets, who have, understanding of what it is like to work with a sponsor, who can be, for lack of a better way of putting it, a bit of a river guide to help you think through, where you want to go and how you want to approach a space, especially if it's a space that you haven't operated in, is an invaluable resource. And then, once you do own a business and you do have that platform, especially in the mid-market, we're often, the first sponsor in the door, and pace of decision-making, pace of, operating, reporting, all of that stuff is very new and requires a, real hand-holding exercise to get people up the curve. So it's a really critical part of the process.
Yeah. Just on the topic of First Institutional Capital and working with founder-led businesses, in the very limited circumstances where Hoop will look to do deals on our own, we often find ourselves partnering in family-owned businesses and founder-led businesses. And I think in situations like that, having a slightly longer term horizon and being able to work with a management team over a long period of time, knowing that we're coming to the table with flexibility in how we structure things, flexibility in our timelines, and flexibility in what we're bringing alongside the successes that that company has been able to generate on their own is a really important consideration for the circumstances where we would look to do a deal with a family who may be thinking at the edges around more traditional up the fairway private equity. And I think the flexibility of our mandate means that that in cases where it may take a longer time to realize that value creation, especially in an environment and with all the challenges that we've been talking about today, that long-term perspective is something that really resonates with families who are looking at transitional considerations, whether that's ownership or taking the business to a new level.
That's great. You know what, and this isn't just directed to Table 19, the Rotman table. I think everyone would benefit from your perspectives on, I think I'll use it as our last question for the day. And we'll start with Jen and kind of move down for this question, which is, what is the best piece of advice that you've received as an investor in your career? Jen?
It's a good question. What comes to mind is something that Ted Forsman once said, which is life is not lived on a spreadsheet. And it's something that my mentor told me multiple times as a former reformed engineer when I first started in private equity. You got to get away from the numbers. And to me, what that means is, look, we can and we must be rigorous in our underwriting and thoughtful, but with a focus on the skew of returns and not trying to aim for false precision on a specific base case. So when we approach that modeling exercise, we're really trying to understand, is it skewed to the upside? Do we have downside protection rather than thinking we're going to be bang on with our base case? It also means to me that in addition to rigorous analysis, you also have to manage the relationships that we talked about, particularly in lower middle market. So that means investing the time up front on education and awareness. It means being transparent and respectful throughout the investment in good times and bad. It's something our CEO likes to tell us, it's how you show up, right? Showing up with that humility and that compassion can go a long way, particularly when you're dealing with founder-led businesses. So that has resonated with me throughout my career, and in particular, as I made the move to middle market.
Thank you. Kirk?
I'll be honest, this is probably going to be a bit of a cliche, so brace yourselves, and I'll probably butcher it a little bit. But you know, and I was chatting about this with a friend of mine this morning. But if you, it's Warren Buffett. So you know, but again, I said cliche.
Sorry, that's your friend?
No. But he does have a really salient point around, and it's around Ted Williams, and it's about the art of hitting. And I'm sure a lot of you in the audience know what I'm talking about. Ted Williams, Red Sox, colloquially known as probably one of the best hitters ever in baseball. And when you do an analysis of Ted Williams and his hitting, you know, if you look at inside, close and inside, best hitter in the league, ever. But if it's high and outside, probably one of the worst hitters in the league. And so it's knowing about where you want to be, where you want to play, and swinging at the pitches that you know that you can hit and where you can win. And I think that you know, when you look at, you know, however many deals we look at in a year, and there's a lot of them, you got to know where you play, and you got to know what it is that you can do, you know, with those opportunities, and do they actually fit in your, not, you know, in your quote unquote strike zone. And I think that's something that definitely resonates with me.
Thanks, Kirk. Anish?
You know, in my career, I've had the opportunity to be both an investor and an entrepreneur, and this advice, I think, resonated in both of those elements. And it was, you know, oftentimes at the beginning, being early and being wrong look very similar. And it's easy when you're an entrepreneur, you know, to have that conviction sort of belligerently that the world doesn't realize they need X, Y, or Z. But it's effectively a prediction that you are basing your conviction on. But as an investor, if you just, you know, did this on this prediction and that's your conviction, that's really a speculative bet. But if you want to generate alpha and not just be a beta play, and Lori talked about, I think actually, how easily it was to make money when capital was cheap and multiples were just naturally expanding. You could be a beta participant and generate attractive returns. But if you want to generate alpha as an investor, oftentimes you have to be at the forefront around something that's changing or happening. And to do that in a disciplined way requires you to have process and practice on how you ultimately deploy your capital. But for me, it resonates in that ultimately, if you're going to go and go take a contrarian view, go against the grain, exercise your process and your practice, it's a reminder to at times also maintain that intestinal fortitude, because being early and being wrong at the beginning oftentimes look very similar.
So the advice that came to mind for me is actually somewhat similar to what you've just said, Anish. And I've spent most of my private equity career, over 20 plus years, working in the private equity platforms of Canadian pension plans. Done that internationally, but I've done that always with a sense of purpose around the members that we're investing on behalf of, and with a long-term perspective. And I think the advice that comes to mind for me is that staying disciplined and taking some of the emotion out of investing with a very long-term perspective around consistency and discipline through cycles is a great way to generate long-term returns and value. And that fear of missing out at the top of the market makes people do silly things. And the fear of uncertainty and risk when things are difficult also means you can miss out on fantastic opportunities. And it's in those periods of change and fluctuation and dislocation where some of the best returns can be made. And the way to position yourselves to take advantage of those opportunities in those moments is don't be emotional, focus on the data, and also, prepare and just have that availability of capital that you can lean into those moments in a way that you're not struggling to come back from mistakes that were made at the top of the market, or being held back by fears when things are looking uncertain and risky. So those are some of the best moments to put capital to work. So it's important to have the capital available and then maintain discipline and consistency to be able to deploy in those moments of uncertainty.
Wonderful. Lori, Anish, Kirk, Jen, thank you so much for spending lunch with us today.
Thanks, Joe. Thanks, everyone.
Thank you. And on behalf of the club, let me just share our gratitude for you spending your time with us today. Lori, Jennifer, Anish, Kirk, and Joe, great job as always, moderating. Thank you. A great discussion. Before we close, let me highlight a couple of events we've got coming up before we finish our season in June. On June 6th, we host Scott Thompson, CEO of Scotiabank. June 10th, we honor Mattamy Homes founder Peter Gilgan with the 2024 Lifetime Achievement Award. June 12th, we'll welcome the TELUS CEO, Darren Entwistle. And then our final event of the year, June 19th, will feature Jeremy Wilmot, CEO of Interac. I'll end by acknowledging the always terrific performance and support from our AV partner, VVC Live, who broadcasts this and makes it available on demand after the event, so please check it out if you want to recap some of the highlights. Thanks again to PwC for your sponsorship, and to all of you in the room and online, thank you for joining us, and we hope to see you again soon. Thank you.